I have been examining this chart for 3 days. Something is incorrect, something that nobody is mentioning, something that transforms everything we believed we understood about Friday's collapse. Initially, I thought I was imagining things. I retrieved the data again, verified different sources, compared multiple charts, but the figures did not alter, and the more I examined, the more concerned I became. Let me demonstrate what I discovered. This is silver, Friday's collapse. 39% decline. The largest single-day decrease in modern history. You probably know this already. Everyone is discussing it. Every headline, every analyst, every video. Silver crashed. Retail got obliterated. Trillions eliminated. But this is what nobody is presenting you. This is what kept me awake for 3 nights consecutive. This is SIL, the Silver Miners ETF, the companies that actually extract silver from the ground. Real mines, real production, real businesses with real employees and real equipment. Now here is where it becomes peculiar. Miners always fluctuate more than silver. Always. If silver ascends 10%, miners typically ascend 20. If silver descends 10%, miners typically descend 20. This relationship has persisted for decades. It is one of the most dependable patterns in commodities. On Friday, silver crashed 39% from its peak, the most violent decline in history. If the pattern persisted, miners should have crashed 60%, maybe 70, maybe even 80, but they did not. Miners declined only 22%. I examined this chart for hours attempting to comprehend how is this possible. The entire silver market is collapsing. Trillions being eliminated, retail investors getting obliterated, and the mining companies, the ones whose entire business relies on silver prices, they barely fluctuated. It made no sense. And then it occurred to me, smart money did not sell. Consider this for a second. The institutions, the hedge funds, the pension funds, the family offices, the people who manage billions of dollars, the people who have teams of analysts, the people who have access to information that you and I will never observe, they did not panic. When silver was crashing 39%, when retail traders were receiving margin calls, when portfolios were being liquidated across the world, the big players examined their mining stocks and declared, no, we are not selling. Why? Why would they retain mining stocks when silver is in free fall? Why would they not dispose everything and rush for the exits? There's only one explanation, because they knew something we did not. They knew the crash was not real. That thought kept me awake all night. If the crash was fabricated, if smart money knew it was approaching, if they positioned themselves perfectly while retail got slaughtered, then there has to be evidence. There has to be a trail. So, I started investigating, and what I discovered made my blood boil. If you are new here, I expose what is genuinely happening in markets while everyone else is distracted by the headlines. And if you find value in this content, it helps the algorithm display this to more people who need to observe it. Now, let me demonstrate what I discovered. In my previous analysis, I demonstrated you how the crash was scripted. 72 hours, Tuesday to Friday, a perfectly coordinated trap. On Tuesday, Trump signaled a weak dollar policy. Every trader in the world heard the same message. Weak dollar indicates strong precious metals. The trade was obvious. Hedge funds accumulated. Retail traders went all in. Billions of dollars moving in one direction. On Thursday night, silver reached 121. All-time high, euphoria everywhere. People were discussing about $200 silver, $300 silver, early retirement. Then Friday morning, 6:00 a.m. before markets even opened. Trump announced Kevin Warsh as the next Fed chairman. Kevin Warsh, a strong dollar hawk. The exact opposite of what Trump signaled on Tuesday. Tuesday, weak dollar. Friday, strong dollar, Fed chairman. Same president, opposite signals, 72 hours apart. The traders who shorted the dollar on Tuesday were now forced to purchase it back. The traders who bought silver on Tuesday were now forced to sell. Forced reversal, forced liquidation, 40% destruction in 6 hours. And somehow, while all of this was transpiring, the mining stocks barely fluctuated. If you have not watched that analysis, it demonstrates you the full 72-hour timeline. But today I'm going deeper. Today I'm demonstrating you who executed this. The names, the documents, their documented criminal history. Let me start with something that most people have never heard of. Spoofing. Spoofing is a form of market manipulation where a trader places large orders they never intend to execute. Here's how it operates. Imagine you want to purchase silver at a lower price. You place a massive sell order. Thousands of contracts. It appears like someone is about to dispose a huge amount of silver on the market. Other traders observe this giant sell order and panic. They think someone knows something. They start selling too. The price declines. Then at the last second, you cancel your fake order. You never actually sold anything, but now the price is lower, and you purchase at the cheaper price. That is spoofing. It is illegal. It is fraud. And for over a decade, the biggest banks in the world were executing it in precious metals markets, and they got caught. Between 2008 and 2020, 5 major banks were convicted of rigging gold and silver markets. Not accused, not investigated, convicted, found guilty, hundreds of millions of dollars in fines. Let me read you the charges. JP Morgan Chase, September 2020, the Commodity Futures Trading Commission issued an order for manipulative and deceptive conduct and spoofing that spanned at least 8 years. Hundreds of thousands of fake orders designed to move prices. The fine, $920 million, the largest penalty ever imposed by the CFTC. But it becomes worse. The traders who executed this did not just get fined, they went to federal prison. Michael Nowak, JP Morgan's head of precious metals trading, convicted of racketeering. Racketeering, the same charge they use against organized crime against the mafia. Greg Smith, JP Morgan trader, convicted. Jeffrey Ruffo, convicted. Christopher Jordan, convicted. These are real people, real names, real prison sentences for operating a criminal enterprise inside one of the biggest banks in the world. And JP Morgan was not alone. Scotiabank caught a $127 million fine. HSBC caught $76 million, 9 years of cheating. Deutsche Bank caught $75 million. They were rigging markets since 1999, 15 years before anyone noticed. Morgan Stanley caught 5 banks, all convicted, all fined. And what occurred? Not a single one went out of business. Not a single one lost their trading license. They paid the fine and went right back to work. This is not conspiracy theory. This is court records, government documents, public filings that anyone can examine. For over 2 decades, these banks were manipulating precious metals while regulators looked the other way. They only got caught because of whistleblowers. And even then, the fines were pocket change compared to their profits. $9 and $20 million sounds like a lot, but JP Morgan made over $40 billion in profit in 2020 alone. The fine was a rounding error. Now, here's the question that kept me awake at night. Do you genuinely think they stopped? A bank pays $1 billion fine. Their traders go to prison. They admit to operating a criminal enterprise for 8 years, and then what? They just decide to play fair. These are the same people, the same desks, the same strategies, the same incentives. The fine was a cost of doing business, a speeding ticket, a line item in the budget. Let me demonstrate you what I discovered when I examined Friday's data. This is the COMEX delivery report from January 30th, 2026. The exact day of the crash. This document is published every single day by the CME Group. It demonstrates exactly who is trading, who is closing positions, who is taking delivery. Most people have never observed this document. Most people do not even know it exists, but it tells you everything. Examine this column. It states stopped. In futures trading, stopped indicates contracts that were closed, positions that were exited. If you were short and you stopped a contract, you closed your short and took your profit. Now examine line 6061. JP Morgan Securities stopped. 147 contracts. 147 contracts closed on the exact day of the crash. Let me explain what this indicates. When you are short silver, you profit when the price descends. JP Morgan had short positions. On Friday, silver crashed 39%, and at the exact bottom, JP Morgan closed 147 contracts. They exited at the lowest price of the day, maximum profit, perfect timing. Now consider this. Thursday night, silver was at $121, all-time high. Every analyst was bullish, every headline was positive. 12 hours later, silver crashed to $75, $46 erased in a single session. And somehow JP Morgan knew exactly when to close. They did not close on Thursday when prices were high. They waited. They did not close in the middle of the crash when it could have rebounded. They waited. They closed at the exact bottom. The same bank that paid $920 million for rigging silver. The same bank whose traders went to prison for manipulation. The same bank that admitted to hundreds of thousands of spoof orders. That bank just happened to time the exact bottom of the biggest crash in history. You believe that was luck? Now examine who else is on this document. Morgan Stanley, 31 contracts stopped at the bottom. Deutsche Bank, 58 contracts stopped at the bottom. HSBC, 60 contracts stopped at the bottom. You observing the pattern? The same banks, the same names, the same players who were convicted of rigging precious metals, all closing positions on the exact day of the crash, all exiting at the exact bottom. This document is public. Anyone can access it. It is on the CME website. I did not hack anything. I did not bribe anyone. I just examined data that is available to everyone. The evidence is right there in plain sight. When I first observed this, I had to read it 3 times. I thought I was misunderstanding something. There had to be an explanation. But there it was in black and white. The same criminals, the same timing, the same playbook. And now I comprehend why the miners did not crash. Smart money knew, the institutions knew, the funds that hold mining stocks, they knew this was not a real collapse. They knew it was manufactured. They knew the banks needed to cover their shorts. So they held. They did not panic. They watched the paper market burn while they sat on real assets. Miners down 22% while silver crashed 39%. That is not a coincidence. That is a signal. But wait, the evidence does not stop there. Let me demonstrate you what the CME executed after the crash. CME Group operates COMEX. They establish the rules. One of those rules is margin requirements. How much cash you need to hold a futures position. On Friday after the crash, CME announced margin hikes. Saturday morning, less than 24 hours later, they announced another round. Starting February 2nd, margin requirements are going through the roof. Gold up 33%, silver up 36%, platinum, palladium, everything. Massive hikes across the board, 36% increase overnight, no warning, after already hiking on Friday. Let me ensure you comprehend how insane this is. If you are holding a silver futures contract, you need a certain amount of cash in your account. If margins increase by 36%, you suddenly need 36% more cash. Most traders do not have spare cash lying around, so they get liquidated, forced to sell, whether they want to or not. Higher margins equal forced liquidations equal lower prices. Now here is what should disturb you. If CME wanted to prevent volatility, they would elevate margins before a crash. They would cool down the market before it becomes out of control. They would reduce leverage when things are getting frothy. That is what a responsible exchange would execute. Instead, they elevated margins after the crash, then elevated them again the next morning, then scheduled another hike for the following week. Consider that sequence. Friday, silver crashes 39%. Retail gets obliterated. Friday night, CME elevates margins. Saturday morning, CME elevates margins again. Sunday, CME announces more hikes for Monday. They're not protecting investors. They're finishing off the survivors. The crash took out everyone who was leveraged long. Now, the margin hikes are taking out anyone who held on, anyone who thought about purchasing the dip, anyone who still has a position. This is not risk management. This is a coordinated execution, and it tells me something very significant. Someone big is in trouble. Consider it. Why would CME elevate margins twice in 3 days to emergency levels? Why 36% overnight? Because someone is underwater. Someone has massive losing positions. Someone is about to default, and they are scrambling to protect the clearing system from the fallout. The crash on Friday was not selling. It was not profit-taking. It was not a correction. It was a forced liquidation bloodbath designed to save someone big at the expense of everyone small. Now, let me place this in historical perspective, because what I am about to demonstrate you proves this is not random. This is not market forces. This is a playbook. This is not the first time they have operated this exact play. 1980 silver advanced from $6 to $50. 800% gain, regular people making fortunes, the Hunt brothers attempting to corner the market, everyone discussing about silver. What transpired? CME created Silver Rule 7 out of thin air. Banned leveraged purchasing overnight, changed the rules in the middle of the game. No warning, no explanation, just new rules that obliterated anyone who was long. Result, silver crashed from 50 to 10. 80% destruction. Thousands of investors eliminated. 2011, silver advanced from $8 to $50. Another massive rally, social media buzzing, retail traders accumulating. The silver squeeze movement was born. What transpired? CME elevated margins 5 times in 9 days. 5 times in 9 days, 84% increase in margin requirements. Result? Silver crashed from 50 to 26, 50% destruction. It took 13 years to recover. 13 years, and now 2026. Silver advanced from 26 to 121s, the biggest rally in history. Social media on fire. Retail investors euphoric. What transpired? CME elevates margins before the crash, elevates them again during the crash, elevates them again after the crash. China elevates margins at the exact same time. Fed chairman announcement timed for maximum damage. Banks closed their shorts at the exact bottom. Result, silver crashes 39% in a single session. The fastest destruction of the three, 1980, 2011, 2026. Same pattern, same tools, same playbook, same destruction. Every time silver threatens to break free, every time regular people start making money in precious metals, every time the price starts to expose the weakness of paper money, the same script executes. Once is an accident, twice is coincidence, 3 times is policy. And that is exactly why smart money held their mining stocks. They have observed this movie before. They know how it concludes. They know the price always recovers after the manipulation. The miners are telling you something. They're not selling. They're holding. They're waiting because this crash was not real. It was paper manipulation, manufactured chaos, a coordinated attack to shake out weak hands and let the criminals exit at the bottom. The physical market knows the truth. On Friday, when COMEX stated silver was $75, dealers around the world were selling physical silver for $120 to $150, a 40 to 100% premium over the paper price. If silver was genuinely worth $75, why were buyers paying double? Why were coin shops sold out? Why was there a line at every dealer in America? But here is where it becomes even crazier. I want to demonstrate you something that transpired this weekend, something that tells you everything you need to know about the state of the physical silver market. Golden State Mint, one of the largest private mints in America, they just shut down silver sales for the entire weekend. Their statement, quote, "not able to secure silver," end quote. Let me state that again. One of the biggest mints in the country could not obtain silver. They had to stop selling because there was no metal to sell. The previous time this transpired was during the COVID panic in March 2020, when the entire world was falling apart, when people were panic purchasing everything, when the financial system was on the edge of collapse. That is the only other time in recent history that a major mint had to shut down sales because they could not source metal. And it just transpired again this weekend, right after Friday's crash. Consider what this indicates. The paper price states silver is worth $75. But the physical market is so tight, so stressed, so completely broken that one of the largest mints in America cannot even purchase silver to sell to customers. If there was real silver available at $75, do you think Golden State Mint would shut down? Do you think they would turn away customers? Do you think they would publicly admit they cannot source metal? No. They would be purchasing every ounce they could find and selling it at a premium, but they cannot find it because it does not exist at these prices. The paper market and the physical market have completely disconnected. The paper price is fabricated, the physical price is real, and the gap between them is not just wide anymore, it is broken. Friday did not just crash the price. Friday shattered the physical silver market, and the cracks are spreading faster than they can contain them. Now let me explain you what I think transpires next. The shorts have covered. JP Morgan closed their positions at the bottom. The other banks followed. The manipulation has served its purpose. The weak hands have been eliminated. Retail traders who purchased on margin are gone. Leverage positions have been liquidated. The market has been completely cleaned out. But here's what they cannot control. The supply situation is not altered. Silver is not optional. Solar panels need it. Electric vehicles need it. Every phone and computer on the planet needs it. You cannot build the modern world without silver. Demand is exploding. Supply is flat. And that did not alter on Friday. Friday's crash did not create new silver mines. It did not reduce industrial demand. It did not alter anything fundamental. All it executed was transfer silver from weak hands to strong hands at artificially low prices. And now the physical market is breaking. Mints shutting down, dealers sold out, premiums through the roof. This is not what a healthy market appears like. This is what a market under extreme stress appears like. I think the recovery is going to be violent. When this turns, it will turn fast. The same algorithms that drove it down will drive it up. The same leverage that eliminated people will make fortunes on the way up, and the physical shortage is only going to become worse. Because every crash like this one drives more people to purchase physical, more people to take delivery, more people to remove their silver from the paper system entirely. The banks can manipulate the paper price, but they cannot print physical silver. And right now, the physical market is screaming at the top of its lungs that something is very incorrect. But I also think something bigger is approaching. The margin hikes tell me someone is in serious trouble. You do not elevate margins 36% twice in 3 days unless someone is about to blow up. The coordinated timing tells me this is global. The physical market breaking tells me even more. When a major mint cannot source silver, when premiums are 50 to 100% over spot, when dealers are turning away customers, that is not normal volatility. That is a system under extreme stress. Something is breaking behind the scenes. I've observed these patterns before in 2008, in 2020. The stress always demonstrates up in strange places before the big crash hits. And right now, the stress is everywhere, in the margin hikes, in the physical shortages, in the desperate timing of the Fed chairman announcement, in the coordinated actions between CME and China. I believe a major market event is approaching in the next few months. I do not know exactly when, but when I decide to exit completely, I will state it here publicly. Like I always execute, a lot of people will regret not paying attention sooner. Now let me leave you with this. 5 banks convicted, hundreds of thousands of spoof orders, traders in prison, and on Friday they closed their shorts at the exact bottom. The miners did not crash because smart money knew. The physical market did not crash because the paper price is fabricated. Golden State Mint shut down sales this weekend, could not source silver. The previous time that transpired was COVID. The physical market is breaking in real time. 1980, 2011, 2026. 3 times in 50 years. Same playbook, same destruction, same recovery after. This is not a free market. This is a crime scene. The question is, what are you going to execute with this information? If this analysis opened your eyes, I need you to execute one thing. Send this to someone who lost money on Friday, someone who got liquidated, someone who is sitting at home right now wondering what transpired to their portfolio. Someone who deserves to observe the evidence before they make their next move. That is how we spread the truth, one person at a time. Drop a comment below. After observing this evidence, do you still trust this market? Are you holding? Are you purchasing? Are you getting out? I read every single comment. Your feedback motivates me to make more exciting content. If this is your first time here, hit the notification because the next analysis might be the warning that saves your portfolio. I will keep investigating. I will keep exposing. I will keep you updated. The fraud is exposed. The evidence is clear. The names are on the record. They want you to panic. They want you to sell. They want you to give up and walk away. They want you to believe the paper price is real. It is not. That is how they win. That is how they have always won. Crash the price. Create fear. Purchase from the panicked at the bottom. Do not let them shake you out. Now watch what transpires.